Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
And welcome to our series on analyzing self-employed income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. In this short tutorial, we'll discuss the key concepts that we use when cash flowing and analyzing our self-employed borrower's income. We'll start with a discussion regarding the differences between taxable income versus qualifying income. We'll then outline 3 key concepts that we use during the cash flowing process. Lastly, we will determine how we go about analyzing the results of cash flowing. So, let's get started. When it comes to how we look at self-employed income, it seems like accountants and mortgage professionals speak 2 different languages. Your self-employed borrower, along with their accountants, are experts at reducing their taxable income. But that is not our concern from a mortgage qualifying perspective. When the borrower is relying upon self-employed income to qualify for a loan, our focus is to identify the income source, confirm the stability of the borrower's income, and analyze the potential for long-term earnings. We would start with the taxable income. We would add back non-cash expenses, business use of home, and one-time losses. We would subtract non-recurring income, account for limited IRS expenses, and review mortgages due in less than a year. During the cash flowing process, we pay close attention to 3 key concepts: non-cash expenses, IRS limited losses or expenses, recurring and non-recurring income and expenses. We use these 3 key concepts no matter what type of business structure we are analyzing. We'll explore these further, but first let's look at a tool that you may find very helpful. When tasked with analyzing self-employed income, we use calculators or worksheets to assist us in this process. Our MGIC income calculators can be found at mgic.com/SEB. The SAM Cash Flow Analysis Worksheet has features to help you further. The green font indicates where to look on the tax forms. The hover triangles provide additional guidance, and the Help Document tab provides further resources. Regardless of which worksheet you use, each of the 3 key concepts is included. So looking at a visual representation, you can see the same 3 key concepts running through the worksheet: non-cash expenses, limited IRS deductions, and non-recurring income and one-time expenses. Let's break these down further. Starting with non-cash expenses, or sometimes called paper losses, these are expenses that did not require your self-employed borrower's business to use any money from their account to actually pay for the expenses. They did not require an outlay of money. During cash flowing, if you encounter non-cash expenses, they can be added back in. Let's take a closer look at 3 types of non-cash expenses. Depreciation is a reduction in value of an asset over time due to wear and tear. Some examples are office furniture, equipment and work vehicles, and office buildings. If we take a look at the sole proprietor section of the worksheet, you may notice that it appears that we are dealing with double depreciation. There is depreciation found on line 13 of Schedule C, and there is mileage depreciation noted as well. This is because there are 2 types of depreciation that we can consider. There is depreciation of business equipment or machinery, and then there is vehicle depreciation. We will discuss vehicle mileage depreciation in detail in an upcoming video. The next type of non-cash expense is depletion, which is the exhaustion of a natural resource. Examples of this are drilling for oil, mining or quarrying of stone, cutting of timber. As you might imagine, this paper loss is less frequently seen as it is associated with a specific type of business. The third type of non-cash expense is amortization, which is an accounting for the loss of an item over a period of time. Some examples of amortization are brands or logos, copyrights, trademarks, and patents, and advertising. An example of amortization would be the cost of a patent. A company spent $100,000 on a patent to guard their innovation. This patent had an expiration of 10 years. The business can amortize this expense over the 10 years prior to its expiration date by writing off $10,000 each year. If you are offering a specific type of investor financing, please double-check with those guidelines to determine if amortization can be added back. Moving on now to the next key concept, IRS limited losses or expenses. When the IRS limits certain expenses, they are generally capped at a percentage of the actual cost. We need to account for the percentage that was not able to be claimed by the company by subtracting the unclaimed amount. The most common limited expense that we will see are meals. Meals are generally capped at 50% of the actual expense. There is a temporary provision in place that will allow businesses to claim up to 100% of meals under certain conditions. Please consult your internal guidelines as to how to proceed. What is the effect of IRS limited expenses on cash flowing? Again, the worksheet will be our guide. In our example of Schedule C, it indicates in the green font to look on line 24B. We see that the borrower claimed meals of $1,500. However, since they were capped at 50%, this means that their actual expense was $3,000. We will input the $1,500 into our worksheet to account for the 50% that they were not allowed to claim. The parentheses means that the worksheet will deduct this figure. Moving on now to the last key concept, starting with recurring income and expenses. Recurring income is what we are looking for. We need to have the expectation that it will continue for 3 years. Recurring expenses are simply the cost of doing business. So we're going to concentrate on non-recurring income and non-recurring expenses. When we encounter other income and we determine that there is no expectation of continuance, or perhaps we don't need this income and we don't want to explore it further, then it must be subtracted. Common other income sources are ordinary income from other partnerships, estates, and trusts, net farm profit, net gain from the sale of business property, or other income that will be identified on an attached statement. Where do we look for other income that might be non-reoccurring? For Schedule C, it will be on line 6. For the 1065 partnership return, it can be items listed on lines 4 through 7. For the S Corporation Form 1120S, it will be listed on lines 4 and 5. For the regular corporation on Form 1120, it will be on lines 9 and 10. Again, remember, it could be outlined on a separate statement. Other income must be analyzed to determine if it is recurring in nature. In order to retain other income, 3 requirements must be met. The source of the other income must be identified. The other income must be related to the business in some way. The other income must have a 2-year history, so the analysis of 2 years of tax returns are required. What is the effect of other income on cash flowing? If you encounter other income that you determine to be recurring, the effect on cash flowing is nothing. The income is already included in the total income and will remain as is. If, however, you determine that the other income is non-reoccurring, it will need to be deducted. If pass-through income of $15,000 is non-recurring, Subtract the $15,000 from the worksheet. If other income of $10,000 is non-recurring, subtract the $10,000 from the worksheet. What is the effect of mortgages payable in less than 1 year on cash flowing? The worksheet indicates that mortgages or notes payable in less than 1 year can be found on Schedule L, line 17, column D. Looking at line 17 at the end of the year, we see the amount of $21,900. $21,900 should be deducted from the worksheet. However, this does not always need to be deducted as long as the lender provides evidence that this is a line of credit or regularly rolls over, or if the business has sufficient liquid assets to pay this amount off. If documentation is obtained, this no longer needs to be deducted. Moving on now to the last part of the third key concept, non-recurring expenses. If you determine that there are expenses claimed by the business that are non-recurring in nature, they can be added back under certain conditions. Non-recurring expenses or casualty losses are described as damage, destruction, or loss from a sudden, unexpected, or unusual event. Examples are fire, flooding, or even theft. To add back in other losses, the source must be identified, and in this case, you should not see these type of losses year over year, because you're trying to show that this is a one-time event. So, for example, if you saw theft on 2 consecutive years of tax returns, this would then be included in the nature of the business and could not be considered an unusual circumstance and therefore could not be added back in. Cash flowing is now complete. What's next? Now it's time to analyze the cash flow summary. In order to assess the stability of income, you need to look at the overall trend of the income. Is the trend in the amount of income stable or increasing, or has the trend in income declined but has since stabilized, or is the trend declining and the borrower has not been able to prove stability? You will need to analyze the overall trend in earnings for each business. Our MGIC SAM worksheet will provide you with a cash flow analysis summary, which you will review and determine how the income should be calculated. There will be 3 approaches to the income calculation. Option number 1, if you have stable or increasing income, you will want to take a 24-month average. Option number 2, if there is declining income, but your borrower has been able to provide evidence that income has since stabilized, you will want to negate the higher year and use an average of the lower year of the 2 years. Lastly, in option number 3, the business is showing year over year declining income, and the borrower has not been able to provide evidence of stability, in which case you would negate both years and no income from that particular business should be used. Now you can see how understanding how we look at income from a mortgage perspective and mastering the knowledge of the 3 key concepts that we use during cash flowing are crucial to being able to calculate qualifying income correctly. Documenting a self-employed borrower's file is a partnership between you and your borrower as we put the puzzle pieces together in order to explain any concerns or piece together any supporting documentation that is required to support the use of income needed for qualification. By being able to communicate effectively from our mortgage perspective, we can collaborate successfully with our borrowers to achieve our mutual goal of obtaining a loan approval. In this way, all parties will leave the closing table feeling good about the part that they played in the process.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.